Welcome to the Deep Dive by TalkTickers.
Your weekly breakdown of earnings calls.
Today, we're plunging into the latest results from Endava. They're a tech services company, right? Specializing in digital transformation.
Exactly. We've gone through their Q3 fiscal 25 earnings call. That's the 3 months ending March 31st.
And we're going to unpack it all for you. Performance, challenges, what they see coming down the pipe.
Yeah, the goal is really to pull out the key insights, give you the core story from management without you having to listen to the whole thing.
All right, so let's jump right in. Headline numbers for the quarter.
Okay, so revenue came in at $194.8 million.
Which is up, what, about 11.7% from last year?
Yeah, $174.4 million last year. And in constant currency, that growth was actually a bit higher, 12.4% year over year.
Okay. And profitability, how did that look?
Much better story there, actually. Profit before tax, or PBT, was $13.6 million.
Compared to a loss last year, right?
A small loss, yeah.
Yep.
$3.5 million loss last year, so quite a turnaround. And the adjusted PBT, stripping out some items, was $24.6 million.
That's up quite a bit from $15.5 million a year ago.
Definitely. And that really boosted the adjusted PBT margin. It hit 12.6% this quarter.
Up from 8.9% last year? That's a healthy jump.
It is. And it flowed right down to the adjusted diluted earnings per share, which came in at 34 pence.
Which was better than their guidance, wasn't it? They guided, what, 31 to 32p?
Exactly. 34p versus 22p last year. And yeah, a clear beat on their own guidance.
So how'd they manage that EPS beat when revenue, you mentioned, maybe wasn't quite hitting forecasts?
Well, that's the interesting part. They basically offset the slight revenue miss with really strong cost control, especially on the SG&A side, selling, general, and admin expenses.
Okay. So discipline on spending made the difference.
Pretty much. Crucial when the top line isn't firing on all cylinders.
Makes sense.
Yeah.
Let's shift to geography. Where's the money coming from?
Okay, North America is the biggest chunk now, 37% of revenue.
Right. Then the UK.
UK at 35%, so pretty close. Europe's 22%, and then rest of world is smaller, about 6%.
And the growth rates in those areas must be quite varied.
Very varied. North America grew a huge 37.1% year over year. But, and this is key, they said that was mainly the Galaxy acquisition contribution.
Okay. So not purely organic. What about elsewhere?
Europe actually declined 10.4%. The UK grew 13.2%, which is decent. And rest of world declined 16%. So yeah, take out Galaxy, and it's a real mixed bag geographically.
And what about their big clients? Any trends there?
Yeah, definitely seeing more concentration. Their top 10 clients now make up 39% of revenue.
Up from 34% last year.
Right. And the average spend from those top 10 clients, that jumped 28% year over year.
Wow. From 5.9 million to 7.5 million on average. So they're really deepening those key relationships.
Seems like it. They're getting more business from their biggest partners.
Okay. And cash flow, how's that looking?
Pretty strong. Adjusted free cash flow was 17.5 million pounds. That's way up from just 2.2 million a year ago.
That's a big improvement.
Yeah.
And the balance sheet.
Solid. Cash position ended at 68.3 million. Borrowings dipped a bit to 136.5 million. And CapEx is still super low, 0.6% of revenue.
And they're buying back stock, right?
Oh, yeah. They've been active, bought back about 2 million ADSs for nearly $40 million by the end of April.
And there's more authorization.
Yep, still got about $60 million left on the current program, plus the board just authorized another $50 million on top of that.
Wow. That's a pretty clear signal about how they see value, isn't it? Calling buybacks the optimum capital allocation tool.
Absolutely. In this environment, returning cash that way seems to be a priority.
Okay, so that covers the numbers. Solid margins, EPS, beat via cost control, but maybe some underlying top-line softness and geographic mix shifts.
Right. And that brings us neatly to how management described the business environment itself.
Which sounds like it's, well, challenging.
That's the word they used.
Yep.
Rapidly evolving, challenging. They specifically mentioned inconsistent behavior from clients.
Inconsistent behavior. What exactly does that mean in practice?
It means basically clients still want to innovate. The desire is there, but they're just really slow to actually sign on the dotted line for large, long-term projects.
So macroeconomic uncertainty is making them hesitant to commit big bucks.
Exactly. Even if they know they need the transformation work done.
And this caution, plus a weaker U.S. dollar late in the quarter, that's what they blamed for missing revenue expectations a bit, particularly in North America.
Yes, primarily North America and also Asia Pacific to some extent. It leads right into the pipeline issue they talked about.
Right, the pipeline itself is growing, which sounds good.
It does sound good, more big opportunities, but the problem is the conversion rate. Because of all the macro turbulence and client caution, those deals aren't turning into signed contracts and revenue nearly as quickly as they expected.
They called it an elongated ideation to production cycle, I think.
That's the phrase. Just takes longer to get from talking about a project to actually starting it and billing for it.
Did they give reasons why some specific big deals got delayed?
They did. They apparently expected to sign about 10 large deals in the quarter, but only landed 5.
Okay, why the shortfall?
A few reasons. 2 clients apparently went into take private talks, which puts big projects on hold. Another client announced a major cost-cutting program. Same effect.
Makes sense. Any others?
Yeah. 2 clients in the auto sector deferred deals related to tariffs because they had urgent supply chain fires to put out.
So external factors hitting their clients, pushing deals back, not necessarily losing them, just delayed.
That's what management stressed. These deals are pushed, not gone. And they were quite clear they don't think internal stuff like integrating the Galaxy acquisition is causing problems. If anything, they feel it's helping them have better, more senior conversations.
Okay, so environment is tough, clients are cautious. How are they responding? What's the strategy?
They're focusing on what they can control. That's the message.
Which means?
Continuing to invest where needed, especially AI, data, but being really tight on expenses to protect those margins we saw.
And the bigger share buyback fits here too, right? Returning value while waiting for growth to maybe reaccelerate.
Exactly. And the other big piece is partnerships. They're really accelerating efforts to formalize partnership.
Why the focus on partnerships now?
To enhance their offerings, basically. Strengthen the value proposition, maybe help break the logjam on some of those delayed deals by offering a more complete solution.
Makes sense.
Yeah.
Any specific ones they highlighted?
Quite a few, actually. They're an exclusive beta partner for OpenAI's services program, already building stuff for clients.
Oh, interesting. With OpenAI.
Yeah. Also an implementation partner for Google Agent Space that's about embedding smart AI agents in workflows.
Okay.
A strategic partnership with Alex Partners, building on a long relationship, aiming for end-to-end solutions. Another with SiteFX, combining machine learning and VFX for things like manufacturing inspection, autonomous vehicles.
That sounds quite specialized.
It does. And also one with Blackbase in engagement banking. They've already rolled out solutions for 7 banks together.
So partnerships, clearly a big part of the plan. And AI keeps coming up. It's obviously still a huge priority for clients, even with the caution.
Oh, absolutely. Management shared some really compelling examples of AI work they're doing.
Like what?
Well, one was with a global pharma company using an AI consensus mechanism to refine clinical trial submissions. They said it achieved up to 19% higher accuracy than human programmers.
19% higher. Wow.
And cut the time needed from hundreds of workdays down to just a few hours.
Hundreds of days to hours. That's transformative.
Exactly. Delivering trusted high-stakes outcomes in regulated environments, as they put it. Real impact.
Any other examples? Insurance.
Yeah. Worked with a major insurer to show how precision prompt engineering, basically, crafting the right AI instructions could speed up workflows and reduce friction in their operations teams.
So practical applications. And wasn't there something about golf?
Yeah. A premier golf brand using Endava's AI for swing analysis and coaching, helping them shift from B2B to B2C.
How does that work?
They built a video analysis platform using synthetic data for privacy, and they're developing an AI coaching agent. The idea is making elite-level analysis scalable for regular golfers. Pretty cool use case.
Definitely different. They're using AI internally, too, hackathons and things.
They are. Mentioned one with a global services company where teams use generative AI for technical tasks, like upgrading Java code or migrating data frameworks. They reported productivity gains anywhere from 50% up to 300%.
So they're drinking their own Kool-Aid, so to speak, using the tech themselves.
Seems that way.
Yeah.
They also highlighted winners from their internal innovation lab final projects involving edge AI in healthcare, AI payment automation. It reinforces that AI is really embedded in their strategy.
Okay, so AI is hot. Let's circle back to that pipeline of bigger deals, the transformative ones. Any updates there?
Yeah, they gave numbers. The pipeline for those large strategic deals actually increased. It's up to 24 deals now compared to 21 last quarter.
So 9 new ones added, 5 won. 1 paused. Still, the potential is growing, even if conversion is slow.
Right. And these are the deals they really want, the ones that build partnerships and get them talking to the C-suite.
What kinds of deals are we talking about? Any specifics?
Yeah, payments and banking is a big area. Working with banks in Europe, Middle East on modernizing their entire payments infrastructure, designing, building, running it, strategic long-term stuff.
Complex, heavy lifting.
Definitely. Also helping clients deal with complexity after mergers or acquisitions, untangling overlapping systems, using their accelerators for that.
Accelerators, what are those exactly?
Think of them as like specialized toolkits or frameworks they've developed. They speed up specific tasks like assessing technical debt, checking system resilience, improving monitoring.
Got it, like pre-built solutions for common problems.
Pretty much. They mentioned using them with a capital markets firm, a U.S. healthcare company, a global financial institution, all deals currently in that pipeline for modernization.
And they use them on deals they've won too.
Yeah, helping a fintech payments provider fix technical debt and manage a data center migration using the Ray and Impra accelerators. Also continuing a big core banking modernization project in North America using their Maps and Dash solutions.
And expanding in U.S. healthcare.
Yep. Landed a new pharmacy benefit manager client. Started with a discovery phase using the Ray accelerator, aiming to automate benefit plan creation later. These examples really show the kind of deep strategic work they're aiming for.
Okay. Let's talk people for a minute. Headcount.
Ended the quarter at 11,365 people. That's up about 3.1% from last year.
And recruitment focuses on?
High demand skills, basically. Data, AI, cloud. Trying to match the skills to where clients are spending or want to spend.
They mentioned a big shift in skills, didn't they?
They did. Lower value work like basic testing is apparently dropping off sharply because AI can automate a lot of it.
While demand for AI, data, cloud skills is way up.
Exactly. Which means they're doing a lot of internal reskilling, but it also means attrition is up a little bit, as they put it. People making that transition, or maybe some leaving if their skills aren't in demand anymore.
But they feel they're managing it, not short-staffed.
They sounded confident, yeah. Said they're making the shift and can staff the business they have.
How does this headcount shift relate to revenue? Headcount growth seems slower than revenue growth if you adjust for Galaxy.
Right. They explain that. 2 reasons, mainly. One is productivity gains from AI efficiency across the board. The other is the shift towards higher value work AI, data, cloud, which naturally carries a higher price tag, a higher unit rate.
So revenue to employee is holding up, even potentially improving, because they're doing more valuable work and doing it more efficiently.
That's the idea. Revenue per head is roughly stable after you account for those shifts.
And those AI efficiencies, they benefit clients too, right? Not just Endava's bottom line.
Yeah, that was a key point. Clients often take the time or budget saved from that efficiency and reinvest it into more work, maybe tackling their backlog faster. So it actually makes Endava more attractive clients get more done.
Okay, interesting dynamic. Let's get to the guidance then. What are they forecasting for Q4 and the full year?
Right, guidance. They based it on exchange rates from April 30th, specifically £1 to $1.34 and £1 to 1.18. Keep those in mind.
Got it. So for Q4, the current quarter.
Revenue expected between $186 million and $188 million.
Which in constant currency is basically flat to slightly down year over year, minus 1% to 0%.
That's right. And adjusted diluted EPS for Q4 guided between 22 pence and 24 pence.
Okay, and the full fiscal year 25.
Revenue guidance is $771.5 million to $773.5 million. That's constant currency growth of 6.0% to 6.5% year over year.
And full year adjusted EPS.
111 pence to 113 pence.
So that guidance clearly reflects some ongoing challenges, doesn't it?
Oh, absolutely. They called out several headwinds. The big one is the weaker U.S. dollar since Q3 ended. They estimate that alone is a negative 3% sequential impact on Q4 revenue.
Ouch. Just from FX.
Yeah. Plus, that slow deal conversion in North America continues, especially in mobility and healthcare sectors where clients are extra cautious.
Anywhere else slowing?
Rest of world slowed more than they expected. UK still facing headwinds. Europe is apparently performing roughly as planned.
Why is the Q4 revenue guide flat to down when the pipeline's growing? Seems counterintuitive.
They were pretty upfront about being conservative.
Yeah.
Because predicting the timing of those large deals converting is so hard right now, they've basically stripped most of them out of the guidance.
Really? Yeah, what?
The low end of the Q4 revenue range assumes 0 pipeline conversion. The top end only includes about 1%, so they're really baking in that client caution and elongated cycle.
That is conservative. And the FX impact on margin we talked about. How bad is that?
It's significant. That move in the dollar versus the pound from 1.24 in previous guidance to 1.34 now, that's an 8% swing.
And since a lot of revenue is in dollars.
Around 45% in Q4, yeah. So dollar revenue translates back to fewer pounds, but the cost base isn't as dollar heavy. That squeezes the gross margin.
That must be.
They implied the Q4 gross margin will be around 31%, down from a normalized 32% in Q3. They even said if the dollar moved back to just 1.30, that could add a whole percentage point to the margin. Shows how sensitive things are right now.
Wow. Okay. Anything else interesting from the Q&A part of the call?
Yeah, a few bits. They doubled down on the idea that internal changes like Galaxy integration are helping, not hurting.
Okay.
Really emphasized the forecasting difficulty due to client volatility and FX, justifying the conservative guidance.
Pricing.
Stable. Average day rates are stable, they said, but admitted they might give some concessions on bigger deals just to get them over the line in this environment.
Makes sense. More on geography.
Just reinforced the North America challenges FX and slower deals, particularly automotive, and reiterated growth is AI, data, cloud, while the pressure's on lower-end stuff like application maintenance.
Confirm the headcount points about AI efficiency and the skill shift.
Yep. Revenue per head stable because of those shifts.
Yeah.
And stressed again that AI productivity helps clients tackle backlogs, making Endava look good.
What about share-based comp? Look low in Q3.
Yeah, they said that was due to performance and timing of awards. Expect it to normalize higher, maybe 3-5% range going forward.
Okay. Anything else stand out? Top client revenue down. Clients over £1.
Top client revenue percentage dipped, partly FX, partly delayed work. The number of clients spending over £1 is a rolling metric, so some churn there, mostly in TMT. Utilization was around 72%, expected to stay stable.
And they talk more about AI, particularly this agentic AI.
They did. That was interesting. Agentic AI, as they described it, is more about building reliable AI systems for specific enterprise tasks, maybe linking different AI tools together.
As opposed to just, say, generating creative text.
Exactly. They see it as more reliable and accurate for complex business processes. Think specific agents doing specific jobs within a workflow. They view this as a really fundamental shift, leveraging those OpenAI and Google partnerships.
So AI evolving towards more practical, reliable enterprise use.
Okay, let's try and wrap this up. What's the big picture takeaway?
Okay, big picture. Endava had a financially okay Q3, beating EPS mainly through cost savings. But they're navigating a really tough macro environment, especially in North America, with significant FX headwinds.
The pipeline of big, important deals is growing, which is positive long-term.
But converting those deals into actual revenue is slow right now because clients are just very cautious.
So their strategy is control costs, buy back stock, push partnerships, and really focus on AI, data, cloud, especially this agentic AI idea.
Right, but the near-term outlook is muted. The guidance is conservative, reflecting all that uncertainty and especially the FX impact. It's that classic tension, exciting long-term tech opportunity versus short-term economic reality. Okay, now for our signature segment. This is not financial advice, where we take all this info and brainstorm an outrageous but plausible trade idea.
All right, we've got this acknowledged air pocket, right? Delayed deals, FX hitting near-term guidance hard.
But, on the other hand, a growing pipeline of really strategic work, strong C-suite engagement potential, and management doubling down on share buybacks.
So here's the pitch. You go long in DAVA ADSs.
The thesis being?
The thesis is that the current guidance is ultra-conservative. They've basically taken the pipeline off the table for now. But that demand isn't gone, it's just delayed. When macro confidence returns, even slightly, that pent-up demand could unlock pretty quickly.
And the big buyback provides support and signals management sees value.
Exactly. It puts a bit of a floor under the stock. The outrageous part is betting this air pocket really is short-lived, maybe just a quarter or two, and that the market isn't looking far enough ahead to the potential growth acceleration in fiscal 26 when that pipeline starts converting.
Okay, what makes it plausible, though?
The fact the pipeline is growing with strategic deals. The concrete AI examples show they're delivering value. And the buyback isn't small, it's a significant commitment. It suggests management genuinely believes the lull is temporary and the long-term story is intact. It's a bet on that strategic value winning out over near-term noise.
Of course, the risks are obvious. Macro stays weak longer, FX stays unfavorable, maybe competitors snag those deals while clients are waiting.
Absolutely. The trade relies on management navigating this tricky period, keeping those client relationships warm and being ready when spending loosens up.
So there you have it. An idea to chew on. But remember,
As always, this deep dive, including that trade idea, is based purely on the earnings call details we discussed. It's for informational purposes only.
It's definitely not financial advice. Do your own research, make your own decisions.
Absolutely.
Thanks for joining us on the Deep Dive by TalkTickers. We hope this breakdown of the Endava call helps you understand the dynamics at play. Until next time.